All right, good morning, everybody. It's Friday, we made it. Very likely we're going to see more tariff talk over the next few days into next week. And there's still an issue with the debt ceiling that needs to be resolved in some way. So we have a lot of potential impacts to the market that we can't see in the candles. One of the things I continue to stress is yes, we need to know how to do technical analysis and read the candles, understand the charts. But a lot of the things that are going to move whatever it is that you want to trade, they're not on the chart you want to trade. They're going to be in headlines or signals from another product. Nothing moves in isolation. So if you're trading something like Meta, you don't want to just sit staring at a Meta chart the entire time. You want to look at other things that could be infected by Meta or would move in step with Meta. They say price is king, and one of the best indicators you could ever use is price. So perhaps looking at price on other things that would move with it or move against it in an inversely correlated way, something other than just looking at that one chart. Add more data. For us right now, that more data is headlines, anything that connects to jobs, inflation, tariffs. Those are going to be the ones you want to pay particular attention to. Right around the world, Japan down about 1%. Hong Kong at about 0.5%. The NASDAQ a little more than a quarter. S&P around a quarter. Small caps basically flat with the Dow. We're going to get PCE data, and we're going to have some Fed speakers later in the day. We have the potential today for a liquidity gap close trade. I like this trade. I like the setup. I like the play. But even if you don't want to use the trade itself, you can use the candle we get to measure out your day. And if you've seen how on the intraday, I like to lay out my drawings, measure the range, plot extensions. You can do all of that on one candle, like the 830 CPI, PPI, non-farm payrolls, PCE, things like that. Just that one 830 candle. We're going to have Fed speakers late in the day. So this is one of those days where, normally we get the morning play and then we get the afternoon play. In this day, one, it's a Friday. Hard to see them being anybody wanting to take swing risk into a weekend with tariffs looming and everything else. So why would they want to, to buy and hold before the weekend? Two, we've got a Fed speaker late in the day. So that's very likely going to affect the trading in the afternoon as well. It's not to say that we can't see some intraday moves, because 0-day trading is alive and well, and more than 50% of the intraday trading that we see is 0-day intraday trading. But when it comes to continued swing trades and longer term trades, it's inconceivable to me that they would be looking to load up with weekend risk and tariffs and everything else that's on the table right now. So with that in mind, one of the things we're looking for is a liquidity gap, a big candle like this. Now, this is a CPI day. It wasn't like today, but we could get a candle like this. One of the characteristics that we're looking for at 8:30 is that we get a big candle, up or down, doesn't matter. But notice there's no wick going in the other direction. This candle went to the upside. There was no downward move, and it closed in the upper 75 percentile, right? So if we was to take this candle and break it into 4 quarters, with 50% being the line in the sand between a bullish candle and a bearish candle on how it closed, then it closed in the upper part. That's another piece of it that we would want to see. Now this one, we didn't get a gap close. You can see how it never came back. So even if we do get the kind of candle that we're looking for today, it doesn't mean that we're going to get the gap close that we want today. Here's an example where we did get the gap close. No wick going in the opposite direction. It closed near the top. It came down and it got the gap closed before 11 o'clock. Or non-farm payrolls here, where it went to the downside. You can see it really didn't try to go up at all. So one direction, no big wicks, a little bit of pause, and then it worked its way to get the gap closed around 11 o'clock. Another one like this, 8:30 CPI. Now this one, it paused a little bit, and the second candle got stuck within that wick range. Then we continued on, put in a round, digested some, came down, got the gap closed around 11 o'clock. So those are some examples of what it is that we're looking for today. What we don't want to see is something that looks a lot like this. Big wicks on each side, price closing very near to where it opened. That's not a gap close trade, but it is a really big signal bar. So we can measure that entire range, and we can project to the upside half of that range and then 100% of that range. While usually I use something like 111 and 1236, when you have a big bar like this, you can use those, the 111 and the 1236, but you'll often see that they'll get outrun. They'll just be run over. When we break the range of this bar, just because of how much violence there is in the price action, volatility. This was not showing the measurement, but if we were to put it on there, that lined up with this top that we had. Same thing, another example of what we don't want. But even if we get that kind of candle, we can measure it, project it to the upside and the downside, see which way we go. Price bounced on the midpoint, so we can also measure the midpoint of this bar. If we think about the half back of it later in the day, that's where price came down and bounced off of it. So there was a response there too. So at 8:30, we're going to get data. It could provide a really big bar, maybe a gap close bar, maybe not. But if it gives us a big bar at all in any way, we can use that bar for analysis. And if it gives us a gap close trade, then great, we've got something to trade as well. It doesn't owe us a big bar at 8:30, right? Price can do whatever it wants, but we're expecting that big bar at 8:30. I don't really care if it goes up or if it goes down. We'll make it, right? We're not dependent on it going one direction or another. Volume at 98 through the overnight. It's within line of what we've seen recently. Nothing stands out there. If we were looking for something to stand out there, is if this morning is supposed to be some kind of big event, core PCE, volume should perhaps be lighter, as if they were sitting out waiting on the data. We would see hedging activity, lighter volume. And from this perspective, at least, we're not seeing that lighter volume. We would also generally expect, if they were worried about it, to see a really tight range, something like this range where we really didn't do much and it would hold through the night. And that's not what happened. We got into the kill zone between 2 and 4 and we had a nice expansion. So the volume that we see, the price movement that we see, kind of implies they're not too worried about core PCE this morning. But we can see that they're hedging. So whether they are trading into it this morning or not, they are hedging it. This isn't my opinion. I'm not assuming that they are hedging. We can see it with the market maker move up here. So Thinkorswim, long ago when it was first being developed by Tom Sosnoff, they were looking for anything that they could promote as a broker that other brokers didn't have. Right? And they made this up. They just made it up. It's called the market maker move. Now, just because they made it up doesn't mean it doesn't have any value to it. I've created my own products over the years, and if you have something that works, then it works. It doesn't really matter if you made it up. What the market maker move is looking at is what we call the front end. This is the options closest to expiration and the next expiration out. When the front end has a higher implied vol than the next expiration out, you end up with a market maker move. There's articles on that at the Schwab website, because Schwab now owns TD Thinkorswim. These articles will explain the market maker move in much greater detail, but they never mention futures. Very likely because in all their infinite wisdom, the articles are written by people who don't trade and never thought to consider the fact that futures also have options. But this is why we know that they're hedging, right? It's why it's not my opinion. I'm not guessing. And of course, they always hedge. Hedging is just a part of doing business. They are always hedged. This is additional hedging, only for today, for a very specific cause and a very specific reason. And even if we didn't know what the cause or the reason was, we can spot it. If you don't have Thinkorswim, but you do have options, then you can just go in and look at the implied vol on the options chain, and you can see market maker move is there or not on your own. So you don't need this tool if you don't have Thinkorswim. So they are hedging. We're going to just assume that it's the core PCE that they're worried about. That's a safe assumption. If after 8:30, the market maker move does not begin to fade, get smaller, and just finally disappear, then we're wrong. It wasn't core PCE. It's something else that they're worried about this morning. And you want to continue to keep your eye on it until it begins to fade out and disappear. This thing will only live for today. The options that are being traded that are affecting the implied volatility that causes this reading, they will expire today. So this is not something that will continue indefinitely. And because it's time-based, midway through the day, it would start to fade anyways. Whether they were closing the hedge or not, it would start to fade because it's running out of life. It's running out of time. So just keep an eye on it. Watch to see if it starts to fade off after the 8:30 print, because that's what we would expect. Since we're basically flat this morning, there's not a lot of edge towards which one of these lines we would hit first. And we would have to get an inside day breakout to hit either one. You know, a lot of times, one of those lines is within the previous day's range, and we don't have to, break a range to get to the line, which makes it easier to hit. In this case, we would have to break out to hit the red line no matter which direction we go. One of the things that implies that today could be violent is the tight range that we had yesterday. It doesn't feel very tight. It's like a 50-point range. Compared to what we've had recently, though, that is tight. Compared to what we've seen, we can see the 21-day average daily range is showing more than 1.75% on a daily average move. That's a lot of movement for the S&P. There was a time where we would see the S&P on an intraday basis maybe move 15 points in the whole day from 9:30 to 4 o'clock, and not just some random day. That was an average daily move. Boring days. Well, those are long past. This range is still a pretty tight range. So we need to get out of this box and then begin to get our play on the day. My argument, though, is going into the weekend, other than 0-day flows, which can drive us up to 58.50, this yellow line up here, or down to 56.35 down here. We could get that just from options flows, but I don't see a bigger change in our situation until next week at least, because we've got to get that tariff news. We found the weekly floor pivot. Been talking about this pivot all week. Monday and Tuesday, I mentioned that we had expanded pretty far away from it, but I thought that it could go a little bit more. Doesn't mean it would, right? But I didn't think that we had exceeded any measured move range, and that we had, gone too far too fast. I didn't think we had triggered anything like that. And this rollover very likely was just a part of the news and the measured move off the lows and everything else. And it very likely had nothing to do with this weekly pivot. But early in the week, I talked about if we start to roll over and head back, this would be the target. Well, we got there. 57.11 is close enough. This says 57.13, but 57.11 cog line. Under that, round number 5,700. And if we had got here earlier in the week, we would be looking for reciprocation to the other side. It's just a really fancy word that says whatever it got to the upside, we would expect to get to the downside. Or if we had started the week underneath, then whatever we had got below, we would expect above. But we would only be thinking that if we had the time to get that done in the week. It's Friday. While we could make this move today, because price can do whatever the heck it wants, it's inconceivable that we're actually going to do that today. So could we? Yes. Headlines could get really bad. Something could really shock the market, catch everybody off sides, and drop us down to basically 56. It's possible. It's not likely. But that would be reciprocation. Looking at today's floor pivot, it's lower than yesterday's. That's bearish. Price opened underneath it, and that's also bearish. We expect price to hit the pivot point every day because it's what it does 80% of the time, and golly gee, it already did. So we don't have an MDP because we've already run up and hit it. Kind of like we did yesterday. When we opened underneath it, we took our time and ran back up and finally got it, tagged it, and that was it. Now we did that tag later in the day. We've done this tag a lot earlier in the day. The day is half done, so it doesn't owe us anything at this point. And if we're looking for a market to just hold the line and wait on data, then we're going to expect to do that. 57.20 was Friday's close. We've got that gap closed now. We're done with that. We could just finish the week within the range and call it good. And if we can close higher than Friday's close, it will have positive headlines connected to it. Because a lot of people, they're just watching the headlines. They don't know much about trading, or they don't trade at all. And they're just going to see that the S&P closed higher this week than it did last week. Yay, right? So that would be the benchmark. If we get to expanding below Friday's close, then last week's low is going to be the line in the sand. $56.50, nice round number. And remember, reciprocation on that floor pivot is 5,600. We're losing the second distribution. The way these profiles work, you have a D shape, you can have a P shape, or you can have a lowercase b shape. When you have something like this, it is not a capital B, it is a D twice. I know, it's just the way it is. I don't make the rules. So we have two distributions, but we're leaving that second distribution. If we try to make a move back to the upside, we've got to work through this high value node, high volume, work through that distribution, which very likely brings the point of control down into this 57.50. And then, of course, if we can get through that, we got a nice shallow area, and then we get up into 58.11 cog line and this higher high value node. You can see in the shallow area how we ran through it really fast. There wasn't much footprint left behind. We would just ran right through it. So if we can break through this zone, we should move through this area relatively easy. It'll just be getting hung up on that higher edge. We've got a point of control from last week, 57.11. And as we were talking about last week with the distribution that we had, this whole thing is a high volume node. Got a lot of structure to it. If we did want to tighten up a little bit, then it'd be something like 5,700 or 5,692. But 57.11 cog line lines up with the point of control of last week. TPO and volume profile on a 10-day, 30-minute chart. We really don't have a classic profile at this point. We got distributions all over the place, high volume nodes everywhere. The point of control on the TPO and the volume profile line up. It's over our head. So if we want to make a move back, we've got to fight through that at 57.50. But otherwise, there's nothing really good here that would point out a classic shape that would give us some insight moving forward. The most that we have to offer here is that the point of control is over our head as a significant resistance, and we would have to get through that to do anything else. We're not going to see this point of control move anytime soon either, unless we go a little bit lower and start building out that 5,700 area, or we go a lot lower and start building out this 56.75 area. That would be the only thing that I could see that could move this point of control anytime soon. Otherwise, any move back to the upside into 57.50 just puts more volume back into the pool that would keep that there longer. And we did get a new VPOC yesterday. That'll work. 57.55. So if we make a break to the upside, we've got that to deal with. Now, some people consider these to be support or resistance. That tends to add bias that I don't think belongs there. I'm not going to call it support or resistance. I will just point it out as a significant level of interest. That's where the greatest amount of volume took place yesterday. At the bare minimum, you could expect when we get back to that spot, a little bit of trader's remorse. So we would expect something to happen there. I don't think that's an unrealistic assumption, and it doesn't add any bias to it that would say, I'm bullish, I'm bearish, I think it's going to be supportive, I think it'll resist the market. If we get near it, we'll likely gravitate to it. Getting beyond it, getting above it, through it, closing on the other side of it, that would be significant too, because we would then be on the other side of all of those traders. We have next week's range already, but it's not set in stone yet. So the range that we've been working with all week, that is locked. It doesn't move. And all these previous weeks that we can see, they're locked. They don't move. But throughout the day today, the one on the right here, it's going to continue to move. The gray line is current price. And then the green and the red line is the range for the week. And everything is just shifting up and down as price moves and as volatility expands and contracts. And at the end of the day, after around 4:15 or so, this is going to lock into place, and then that'll be our new range for next week. So what I like to do on Friday mornings is put a box on the week that we just had, and then move that over and compare it to what we're projected to get next week. It just offers a little bit of insight on how things look. Does next week, forecast greater volatility, less volatility? And since the width of the range is based on time and volatility, we can kind of get a pretty good idea what the market's expecting for next week. The sneaky part of this is that things like FOMC are volatility suppressing events. So if we had FOMC next week, for an example, we could expect to see a smaller range because we are waiting on FOMC in a forecast. I know that doesn't make much sense, at first glance, but markets will often go sideways into CPI, PPI, FOMC, big events. They'll go sideways in front of it. Like we did yesterday before today's core PCE, we went sideways. So a narrower range implies that the next week has lower volatility, but that lower volatility implication generally is a threat. It tells us, hey, there's something big coming in next week, and the market looks like it's going to go sideways in front of it. The day isn't done, so this range isn't set, but next week looks like a narrower range with lower volatility. And if we think about what next week provides, it's the quarter end, right? So we have like one day before this month is done and the quarter is done. We've got tariffs, the debt ceiling, and man, ain't that enough? That's quite a bit. So it's not a surprise that the range is narrower for next week because of all of those headline risks. We're back below the 10-day. So, the idea that we would run back up, get a reset like we have back here, and then work our way to the downside, well, that's certainly working out. We didn't stay above the 10 for very long before getting back down below it. And it's likely that we continue to spend a lot of time below the 10 in the current market backdrop that we have. There's just so much uncertainty and a lack of sentiment, trust, confidence. And that is the one of the biggest drivers that we need to see change. It's hard to bring back confidence. Looking at the weekly, we're still 2% below the 10-week. Now, this doesn't show the curling over yet and moving farther away from the 10 yet, but that's likely what we're going to see if we continue to fade down towards the lower edge of the weekly range. And if you look back, it's rare to see us move up towards the 10 and not get there. This is the 10-week we're talking about. To move back towards the 10-week, not get there, and then continue to fall away from the 10-week. We've done it before in 2023, in the later part of 2023 when we got weak, and certainly we did it in 2022 in the bear market. But this is not the kind of price action we're all looking for, right? Just go back to 2022 and take a look at it. Pretty sure you're going to agree that that's not what you want in your long-term accounts, your long-term portfolios, that kind of weakness and bleeding. This is the 9 sectors that I tend to look at. Top 3 are risk on, the bottom 3 are risk off. The 3 in the middle are what we call the midline. When you think about it from a growth versus value perspective, value would be on the bottom, growth would be on top. And if we're looking at a growth value ratio chart, you can see whether or not growth is outperforming or value is outperforming. Those are the kind of metrics that we can use to get a gauge on how things are doing out there, if we're getting any sort of capital rotation, hedge fund factor rotation, short covering rallies, that sort of stuff. With this, I've got the labels in the corner showing a change over the last 5 days. And a couple of moving averages that just big picture moving averages. 200 period is purple, 50 period is orange, and then the white line is what we call a LINREG, linear regression line. Markets above their 50 and 200 are considered healthy, and the slope of that 200 really tells us the direction of the broader trend. So if you look at financials, purple line is still pointing to the upside. Price is still above the 200, although it is fighting with that 50. But if you take a look at tech, we're completely below both, and we're looking to see a 50-200 cross to the downside. That's not a sign of health and strength. Consumer discretionary, we're under both, although we did pop back up into the 200, so we popped up into resistance. We don't have a 50-200 cross event yet, but I would say, it's in the runnings. Certainly not a picture of health when we're underneath the 50 and the 200 like that, and it's curling over. It's not still pointed to the upside like the financials. Consumer discretionary, going in the completely opposite side of growth and value. 200 starting to flatten out. We've crisscrossed back and forth through these two moving averages, so they're not support, they're not resistance, they're just a picture on overall market health. That flattening out 200 and crossing back and forth above and below it shows that there's just nothing here. If we begin to expand below it, it'll easily drag that 200 with it. Same thing with healthcare. They're tangled up sideways, crossing back and forth through it. Even the LINREG line is almost sideways at this point. Utilities keeps resting on that 200, but for how many more times? Right? How long can you test a trend line before it finally breaks? So if we're looking for strength, if we're looking for the health of the broader marketplace, this sure doesn't show us a lot of strength. Doesn't show us a lot of conviction and trust, confidence in the market, money flow. And sure, we've got green tags, blue tags showing positive 3%, 2%. But in bear markets, we can get some of the biggest moves in history have come to the upside in bear markets. So we can get up days, we can get multiple days to the upside. But this is just a whole lot of weakness and risk and big signals that could drop us to the downside. Doesn't mean we're going to go down, but we're primed for some big moves. I keep coming back to utilities. You know, there's that phrase that says markets don't crash from overbought conditions. Markets crash from oversold conditions. Consumer discretionary, utilities, technology. We had these big moves to the downside and then a pause and a consolidation, like it's trying to heal and it's trying to stop itself from getting a much deeper drop. If we were looking for a market to crash, you know, those three look like great examples, great candidates of markets that could crash lower from here. Two of those are great representations of the Mag 7, or the Lag 7, as I've heard them called lately. So looking at markets that are up and down this morning, Bitcoin is down, China, and really that's it. Out of all of these names that are up more than 0.5%, China, 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 Bitcoin, Bitcoin, China. And then we've got triple X semiconductors are also down. Looking at what's up this morning, gold and bonds, and the VIX, of course. If we're going to get a rally day, it's going to have to come from the options flow or news, not from the broader market breadth. %8 of the S&P is down 0.5% or more, and we can see out of those 8 names, 2 of them are semiconductors. 24% of the NASDAQ is down 0.5% or more. Couple of semiconductors in there. Only 3 names are up more than 0.5%, one of them being Tesla. And 7 names in the NASDAQ are up 0.5%, with one of those being Tesla. So we got nothing, right? We don't have any push. No broader market backdrop, no rising tide to lift the boat through Mag 7 or anything like that. It's going to have to be headlines or options flows. Now, don't get me wrong. We could get something like something from Treasury, right? Maybe a move in the 10-year or a move in the 2-year or the dollar. We could get something like that moves the market today. But what would move those that would move the market? Very likely a headline. So that just brings us back to, if we're going to see a rally today in the S&P and the NASDAQ, it's going to be a surprise headline in the news that we didn't see coming, or it's going to be options flows today. Which is kind of nice, I guess. It just narrows down the things that you have to look at today if you're looking for, those signals that we're going to break out and run. So that's what I got for you guys. Watch the clock. Be careful. Be safe. I'll see y'all next week.